Good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we entered this week's market conditions somewhat similarly to last week for different reasons. Last week, we started off the week with a pretty negative tone here after news out of China with the DeepSeek AI model and the results of that potentially concerning to the pace at which US tech firms were spending on AI and the developments out of DeepSeek and what they were able to produce at the cost at the levels of cost that they were able to produce really spooked markets here last week. But however, by the end of last week, we saw markets had recovered most of the losses to basically close again near all-time highs on the S&P 500. But over the weekend, with rhetoric around tariffs, or rather the actual implementation of tariffs for Canada, Mexico, and China, again spooked markets as it seemed, what was initially viewed as a softer tone on tariffs quickly became more of reality. But as we can see, less than 24 hours later, a lot of the concerns around tariffs have been reversed again due to Canada and Mexico being at the negotiation tables. Seemingly, China has responded to President Trump's 10% tariffs on China. So, markets opening today fairly stable from where we closed yesterday. We also have seen the tariff playbook from President Trump's first term, where initially markets reacted negatively to the actual news of the tariffs, and then over time largely have recovered from there, partially because tariffs have been largely used by President Trump as a negotiation tactic to generate leverage for the United States. And from what we've seen so far, that seems to be very much in play once again. So as we look at the S&P 500, we basically open up the week just below the 50-day moving average here. The one thing, what we do continue to see here is the fact that we've made two attempts at new all-time highs above 6,100. Both times have failed. If you look at the NASDAQ 100, we made another attempt at all-time highs that also failed here again. So we basically so far have a series of lower highs and now potentially lower lows as well. If we turn back to the Russell 2000 small cap indices, we saw that we basically failed over the past few trading sessions to get back above the 50-day moving average and is now trading lower as a result of that. And then also, if you look at the equal weight S&P 500, same thing. Attempts to get back above the 50-day moving average and towards that all-time high so far have failed here again. So just overall, when we look at price action here for equities, we don't start off the week on a particularly strong note, and the tariff news hasn't particularly helped that. We do see a little bit of stabilization here today, but it very much speaks to the fact that markets are nervous, markets are jittery, and this means that any sort of bad news right now is being interpreted as, opportunities to sell. So that's the market that we find ourselves in. As you can see, growth has continued to underperform value here over the past, call it month and a half. We have seen commodities find a little bit of support here after gold and oil have gold reached new all-time highs and oil kind of lifted off the one month lows here on the back of Trump tariffs. We have seen high yield corporate bonds after reaching a new 52-week high started to sell off here again, but largely still remaining on in risk on territory here from the bond market perspective. We did see VIX yesterday spike to around that 18.5 level here, which really speaks to um, an elevated amount of fear in the equity markets. We basically started off the week above 16%, which is somewhat rare when you have the S&P 500 within spitting distance of all-time highs and the VIX trading up into that 16 handle. Again, speaking to the fact that there's an elevated amount of fear in investors at the moment, demanding higher levels for put protection at the moment. So market's very much in a bit of a jittery pattern here right now. If you look at kind of 10-year yields, we hover just below 4.6%. This is going to continue to be a bit of a headwind here for equities. Any any optimism around growth and optimism for the new administration is going to be facing these headwinds right now for for equities, not to mention the relatively high multiples the S&P 500 and the Nasdaq 100 continue to trade at, which is going to some degree limit the upside potential here for equities at the moment, especially with 10-year yields back above around 4.6%. We continue to see bonds sell off here, testing that 50-day moving average. And so far, based on yesterday's price action getting rejected off of that 50-day moving average. So continuing potentially a downtrend here for bonds. You have the dollar index continuing to rally here above that 108 level here to the upside. And gold, as you can see, has now reached 28.57 here. So a new 52-week high that we've gotten today on gold and continues to rally here. We continue to see gold demand remain incredibly resilient, and we saw oil kind of trade off of these lows, off that $72 low here. So after breaking out above 72, trading all the way up to 79, is now finding some support around that $72 level here on West Texas Intermediate. If we look at the sectors, we continue to see outflow from technology. This is really one of the sectors that we continue to see outflow in. So this is a very kind of risk-off tone, a less offensive tone here for equities. And if you look at kind of where the flow is, right, we've seen consumer discretionary remain strong here, but a little bit of outflow here yesterday. Communications is really one of the strongest sectors here right now. Financials is also one of the strongest sectors here right now. And then we see quite a bit of outflow here. Consumer staples showing a little bit of strength here over the last couple of weeks after what has been multiple months of underperformance here. Healthcare also seeing some inflows here. This is a much more defensive tone that we're seeing here with the markets, with healthcare outperforming, materials outperforming here as well, industrials underperforming, and then real estate, energy, and utilities all underperforming here relative to the S&P 500. And home builders sold off substantially here yesterday on the back of the news for the tariffs and 10-year yields rising back towards 4.6%. I expect that this sector will likely continue to underperform in the future, given where interest rates currently sit. And semiconductors also continuing its underperformance here. We've seen semiconductors underperform the S&P 500 by a pretty wide margin. And over the last couple of months, we started to see what looked like an early signs of some recovery. But so far, we've given all of those gains back here in just the last couple of weeks and kind of reversed all of that. And this kind of continues at the moment, the underperformance here for semiconductors at the moment. So, from a macro picture, we start off the week in a much more bearish tone here to the overall markets here at the moment. Now, looking at some ideas here for the week, looking at some new ideas for the week. First one I want to take a look at here is Amgen. Healthcare stock. We've seen healthcare outperform a little bit here over the last couple of weeks. Amgen, a pharmaceutical stock, as you can see, recently kind of bottomed here below that 280 level here to the downside after underperforming for the past few months, uh, formed this bottom here and recently broke out here above 280. And if you notice here on the breakout, is recently outperformed the S&P 500. Those are the typically things we'd like to see when the stock breaks out from a resistance level. Is you want to see the breakout on an absolute chart, also followed by breakout on a relative chart. We're seeing that here right now with Amgen. Amgen trades at only about 12, 13 times forward earnings, even though it's growing basically on par with its industry and is more profitable than its industry. So from a valuation perspective, leaves quite a bit of room here to the upside. Our upside target here is around this 325 level here, which is the prior highs before that sell-off. That would be our initial upside target, with currently trading at 288, leaves a fair amount of room here to the upside for Amgen. The next one I want to take a look at here is Quanta Power. So we've seen the pullback here of a lot of industries with the news out of DeepSeek here last week. And if you look at Quanta Services, power generation uh, conglomerate, recently pulled back here to this important level, this 290 support level here. Now, if you think about the future of AI. There's really the semiconductors, the software stocks, those are kind of the most obvious plays with regards to AI. But if you kind of dig a little deeper from an industry perspective, we quickly see that the scalability of the AI infrastructure for utilization going forward, a big part of that is actually power generation because the servers that power these AI farms are incredibly power hungry. And this is actually one of the areas where China is far outpaces the United States with regards to our ability to build out power infrastructure. So this is really where companies like Quanta Services are the leaders in this particular space in the US. So if you need to build out power infrastructure for a large number of data centers, we're talking about gigawatt level data centers. It's Quanta Services that would largely be behind the scenes of those kind of power generation build outs, in addition to utility companies. So that's really kind of where we see some opportunities here in the future for these types of companies with regards to the AI um, landscape. And with the recent pullback here to this major support level, the risk reward level starts to look very attractive here to the upside for firms like Quanta Services. Now, I do want to bring up Lam Research. Lam Research, LRCX, sorry. Lam Research, they are one of the primary builders of semiconductor fabrication equipment behind ASML. And as you can see recently, Lam Research, after what has been a underperforming stock here throughout the summer, has really found some stabilization and started to bottom out here throughout kind of the later stages of 2023. And what we saw here, 2024. And then basically to start off the year for 2025, we started to see this breakout here. Now, it pulled back here last week with the DeepSeek news, but we started to break back out here above that $80 level. And this is where we think there's a fairly substantial amount of upside here for Lam Research, trading at about 21 times forward earnings, which is not cheap, but also for the semiconductor industry, fairly in line with industry standards. However, if you look at growth potential here for Lam Research and profitability metrics, this is really where Lam Research exceeds the industry on both metrics for both growth and profitability. So the fact that it trades basically at a slight discount to the industry median leads me to believe there's also further upside here for Lam Research. Our upside target here is closer to that 110 level, basically recovering back to those July highs, especially if you consider kind of the necessary demands for memory chips in the AI infrastructure here, especially if you think about like um, the sell-off last week with DeepSeek R1 that caused that sell-off. It's reasoning API, I'm sorry, reasoning AI models that are now the leading frontier models. And reasoning models are very different from the traditional models that have kind of led AI for the last couple of years. If you look at ChatGPT 4.0, if you look at Grok 2, if you look at Claude 3.5 Sonnet, these are the leading frontier models from an AI perspective. Those are all just general purpose AI models. It's really ChatGPT's O1 model that was a bit of a leapfrog here earlier last year in 2024 that DeepSeek R1 is competing with. Those are the power hungry, memory hungry, intensive processing uh, power and memory intensive uh, uh, algorithms that power, I would argue, the future of AI. And if you look at Lam Research, they are the primary equipment providers for the fabrication of the memory chips that power kind of AI, the AI revolution. And that's really where we see some potential opportunity in the future. And this is why the breakout here above 80 is fairly significant here as the potential early signs that investors are paying more attention back into the semiconductor space. As you've seen, semiconductors continue to underperform, but this is one of the few stocks that is continuing to outperform the markets here within the semiconductor industry. So Lam Research remains one of our top choices here at the moment within the semiconductor space. The next one I want to take a look at here is Pepsi. We talked about this here last week, but Pepsi, trading at about 16 times forward earnings looks like it's pretty inexpensive here right now, especially since you've seen this decline, a pretty steep decline here since October. The fundamentals of the company hasn't really changed much, but with this steep decline here in the stock price, it starts to look more attractive from a valuation perspective. We saw how oversold Pepsi was. We're expecting a bit of a bounce here, and that's exactly what we've gotten so far. We've pulled back here a little bit here again, and this is really where we think the risk to reward continues to look attractive here to the upside. Growth metrics and profitability metrics largely are in line with the industry, but the fact that it trades at a discount relative to the industry is really what creates a bit of a short-term opportunity here for Pepsi, especially since it's oversold on uh, both daily and weekly time frames. Another one I want to take a look at here is a bearish opportunity here with Take Two. Um, Take Two is trading at a pretty high valuation considering the fact that it's not profitable. As you can see, it recently has kind of failed to continue to break higher here above this 192 level here that you have a bit of a triple top. It hasn't broken below the support level here just yet. You have support here around 177, but if you look at valuations, this is really where the valuations currently is somewhat unsustainable, especially for a company that's not profitable and continues to decline on both revenues and profits. So this is really where our outlook here is we're looking for a breakdown here below 177 and potentially for this to come crashing back down towards the 157 level, which is our kind of our downside target here right now, around 157 and a half for Take Two. Visa is another one that we really like here at the moment and has continued to move higher here. It beat earnings here last week. We basically started looking at Visa when it started to break out here above 315. It really has continued to run a very high really nice rally here in the very short run. I would like to wait for a bit of a pause here for continuation higher, but Visa from a valuation perspective remains one of the strongest contenders here from a valuation perspective because of how profitable they are. They trade at about 28 times forward earnings, which is not cheap. But if you consider the fact that they are one of the few tech stocks with a margin north of net margin north of 50%, it really makes that 27 times forward earnings far more reasonable here, especially if you look at some of the other names that are currently on our list. Another one I want to take a look at here is Apple. Apple continues to underperform here. Um, Trading at 31 times forward earnings, 31, 32 times forward earnings, this is largely untenable for a stock that, is growing at, low double digits, high single digits for both top and bottom line. You basically have EPS growth that's, in the 10, 11% range. You have revenue growth that's in the 8 to 9% range. Those are not particularly growth numbers to write home about. And we continue to see iPhone 16 sales languish. We've seen their newest kind of innovation with regards to the Vision Pro continue to sort of fail, especially with Meta and Snapchat kind of eating their lunch in that particular space here at the moment. Apple is looking more and more precarious as kind of their primary driver of revenue is continuing to lose ground in terms of sales. They don't own any of their own AI technology. They have to lean on 100% external companies like OpenAI. That basically ensures that they will always be behind the curve with regards to the rollout of artificial intelligence within iPhones. And just the valuation that it trades at 32 times forward earnings is more expensive than Visa, it's more expensive than Alphabet, it's more expensive than Meta, it's more expensive than Nvidia, and all of these stocks are far more profitable and grows far faster and trade at much lower valuations. So I cannot stress enough. I've been talking about this for multiple weeks. Apple remains one of the most expensive stocks in the tech space at the moment, and I believe it's a better opportunity to be short Apple and long the other names that I just mentioned. So I'll go over the rest of the ones that I just talked about here. I'll start with Alphabet. Alphabet currently trading at about 22 times forward earnings. As you can see, recently just broke out to new all-time highs here above that $200 level. And not only do we get a breakout to new all-time highs, it also outperforms the S&P 500 with that. Alphabet relative to Apple growing far faster, top and bottom line, is just as profitable as Apple, but trades at 22 times for forward earnings versus 32 times forward earnings. And that's really where I think Alphabet maintains a much better investment than, let's say, Apple, especially if you look at kind of Alphabet's um, potential here with AI relative to Apple. Meta is the other one that I wanted to bring up here. Now, Meta did quite well on earnings here last week, broke out here above the 640 double top. Not only did we break out here to a new all-time high, we outperformed the S&P 500 as we did that. So Meta trades at about 26, 27 times forward earnings. In terms of growth metrics, very similar to Alphabet. 35% net margin, so higher profitability than Apple, faster growth metrics than Apple, yet it trades at a pretty substantial discount relative to Apple. So these are all tech stocks that are growing faster, more profitable than Apple, yet trades at lower valuations than Apple. And the last one here I want to leave you with is Nvidia. Now, Nvidia has obviously taken a pretty big hit here after last week's news from DeepSeek. We've now pulled back all the way to around 116 or so. And this is really, in my opinion, represents one of the best value plays here at the moment with this recent sell-off here. A lot of people complain about Nvidia and the price that it trades at, but it only trades at 26 times forward earnings yet. Now, there is no other tech stock that is growing top line north of 60%. I'm sorry, growing bottom line north of 60%, meaning growing earnings north of 65%, there's no other tech stock growing revenues north of 50% year over year, and there's no other tech stock in conjunction with that has net margins greater than 55%. So the fact that you have no stock that's even in the same realm as Nvidia from a growth and profitability metric, yet it only trades at 26 times forward earnings, which is cheaper than Meta, which is cheaper than Apple, cheaper than Visa, cheaper than a lot of the other stocks that we talked about here today that we still continue to like at those valuations. That represents, I think, one of the best value plays here right now. So Nvidia at 140 was a good valuation. I think at 116 is an even better valuation here right now. And it's um, now I get it. It's underperforming the S&P 500 right now. It seems pretty risky right now to be owning Nvidia or buying at these particular levels. But that's really where I think, in order to truly buy low and sell high, you have to be going against the trend of the market. And that's really kind of where I feel we are right now with Nvidia. And I'll leave you with just a couple of other names here before we wrap up. The first one I want to take a look at here is Boeing. We continue to see kind of the turnaround story here with Boeing continuing to take shape here. We basically looked at this kind of breakout here above 165 as basically the completion of this kind of call it this bottoming formation, right? You have this bottoming formation that basically got completed around this 165 level. We broke out above, came back and retested this level of support, and now broken out higher here again. It hasn't broken out here above 185 here. We really would like to see that breakout here above 185 to further confirm Boeing's turnaround story here. But we've seen the CEO of Boeing move to Seattle. He's taken a much more hands-on approach versus the previous CEO. He's he's moved past the labor dispute. He's really started to focus on deliveries and safety, kind of shut down the assembly line 30 days, even though the labor disputes were resolved to try to focus on safety and just a general culture of Boeing. So very early days, but investors clearly paying attention to here. To what's going on here in Washington, and I think represents some superior upside potential here for the aerospace industry. And then lastly, I'll leave you with one last one, which is um, uh, XYZ, block. So this is a recent symbol change. Block, which used to be square, was SQ. Symbol change to XYZ. Basically, as you can see, we kind of pulled back here to this $87.5 support level here. We traded below this level for a couple of months, for a couple of weeks here. We have managed to get back above this level, and this is really where I think the upside opportunity lies here in stocks like Square or Block. Significantly faster than industry average in terms of growth rates. Where they need to work on right now is profitability. Their net margins here are only about 4 to 5%, versus the industry average is closer to 15%. And this is really where their focus on profitability is starting to pay off here. And investors have paid attention here this year. This was a $70 stock that's rallied into that $100 range. And then now it needs to break out above that $100 range onto our $140 upside target here for Block, and that still remains one of the stocks that we like here at the moment. So that rounds out, where we currently stand here from a macro perspective, starting off the week on a slightly weaker foot, and just our overall outlook with some ideas here for the week. With that, I hope that this helps you kind of start off your week on the right bigger picture tone, and then looking at some ideas here for the week. With that, thank you so much and hope you guys have a great trading week. And I'll see you guys here next week.